Welcome to Vantage. Finally, I've been trying to track this manager down for a couple of years. He's agreed to come on. Delighted to come and talk to this individual who has been managing a high conviction global portfolio. Some great US success stories there, but he doesn't like to be called tech or growth. Let's go take a look. Welcome to Vantage. In December 24, we made a call, and it's a prescient call. We thought that actually it was time to rotate out of the US equity market and start looking further afield. I am delighted to finally have got someone who has been investing very successfully in the US and is also starting to sell out of some of the sort of Magnificent Seven. Welcome to Vantage, Stephen Yiu. To start off with, I mean, you're a reasonably well-known personality, but co-founder of the Blue Whale Fund, CIO of the Blue Whale Fund, managing about 1.2 billion of sort of capital. I'd love to get a little bit of the backstory in terms of your journey, how you got Peter Hargreaves to sort of you're working at Hargreaves Lansdown, how Peter Hargreaves invested with you, and the launch of the Blue Whale Fund. So let's start with that.
Thank you, Neil. So the journey basically started just over 25 years ago when I worked at Hargreaves Lansdown in Bristol for Peter. I spent about 5 years there, got on very well with Peter. Obviously, I then left HL to join New Star Asset Management, followed by Artemis, and then later on with a hedge fund called Nevsky Capital. And Peter and I got on very well together, and then we were exploring to do something ourselves back in 2016, just over 8 years ago now. And we decided to kick off the project. So at the time, my rationale was to launch a strategy that would allow me to maximize our performance or run a global mandate that would allow us to have the flexibility to invest into the best opportunity set globally. And at the same time, we also want to run a high conviction mandate, which would give us kind of the mandate to be able to maximize the performance, because ultimately if you ended up running too many stocks, then the level of conviction that you would have in those companies, even though they ended up doing quite well, it would not be able to translate into performance of the fund as much as if you run a high conviction mandate. So that was how we got together 8 years ago, and then we started the journey, and Peter very kindly seeded the fund with £25 million, and then here we are 8 years later.
Yeah, and it's been look, I mean, with the caveat that past performance is no guide to the future, but it's done well. You've delivered, last I looked, 157% return since launch compared to an 80% if you'd gone into the global index. You consistently push back against being labelled as a growth fund or a tech fund, but when you look at the portfolio, technology is a pretty significant portion of what you're investing in. So explain to us effectively the contradiction that you're not a tech investor. So what is your investment philosophy if it's not growth or tech?
So on a very high level, we like companies that are of high quality, so run by good management teams, strong balance sheet, being able to deliver sustained level of free cash flow generation over an extended period of time. But at the same time, we also like to invest into companies that have opportunities to grow, to become bigger, so they would be able to make more money by either selling new products, going into new geographies, or becoming the market leader to take market share from the peer group, etc. So there's an element that you want to have the best of both worlds, not just quality businesses that doesn't have opportunity to grow in its own right. But what has been quite interesting in terms of our journey was when Peter and I decided to come up with a name for the fund. From Peter's perspective, that was such a long time ago now. In his mind, there's only two strategies in the world. One is a strategy that pays an income, which is a dividend kind of income strategy. Another one would be capital growth. So obviously, this is not an income strategy. We want company that can grow over time. And then he decided to name the fund, call it the Blue Whale Growth. And what was interesting then, since the journey started, that we got labeled as a growth strategy alongside some of the very successful growthy fund, maybe during the pandemic. And what is very important to note was since 2022, our performance started to differentiate versus a lot of those strategy. And hence, if you ask me today, like what is the strategy, I would say that we have a bias to quality businesses and we like company that can grow. But at the same time, valuation is very important, that this is not a strategy that invests into unprofitable growth, if that's the right term, that you're spending a lot of money to win market share, hoping that you become the market leader. This is not like that. And the example that I would give equally is like Nvidia, which I'm sure we can talk about later, that Nvidia has been a very successful company 20 years in the making. Right. By the time it got to 2022, it was already making $30 billion top line. Okay, today it's making $200 billion. But it wasn't a company that just came out of the blue and become very successful as like one of those kind of scenarios. So Nvidia in itself, even though before the AI journey started, it was already very successful. But of course, what happened in the last couple of years, from our perspective, that's a very interesting company for us to own.
Yeah, and you run. I get it. So high quality names. It's quite a concentrated portfolio. So it's not like some of the funds where it's almost index exposure, 150, 200 names. You've got 25 to 35 names typically. Your top 10 holdings are representing 60% of the fund. It's pretty concentrated. So it speaks to the idea of conviction. Walk us through, the construction of the portfolio, and then also, I guess, how do you manage the risk with such concentration?
So the first starting point, this journey started 8 years ago, was one of the things I've learned as a fund manager, having run money across different strategy, was that you want to be able to express your conviction into names that you really believe in, or you have a bit of a differentiated angle in terms of research that you have done versus your peer group of the market domain. And hence we decided that we want to run high conviction mandates. But equally, of course, when you're doing it on a practical basis, this is a real portfolio with real money. A lot of investors are invested with a strategy that you equally want it to be quite balanced in terms of opportunity that you have across different geographies or sectors or end markets. So the way that we do it is this is a UCITS constrained fund, so it's subject to 5, 10, 40. No single position will be more than 10%. Yeah. The top 5% position would not be more than 40 as a whole. So this is a regulated kind of regulatory requirement. But at the same time, from our perspective, is we want to welcome as many ideas that we can find globally that are very interesting. So if I just name a few that give you a bit of a flavor, like we have AI, obviously Nvidia, Broadcom done exceptionally well for us. Yeah. We have Leonardo, European defense, also done very well for us this year. And then we like Flutter, which is in the US sports gaming space. Yeah. Very different in the US, not related to AI or European defense. And equally, we have like Philip Morris, Montclair, and biologics. So that when you then think about what we are interested in is idiosyncratic opportunity globally, while they fit the criteria being high quality businesses with growth opportunities, and then you want to have as many of them as possible. So 25, let's say, just roughly, and hopefully then we will be able to do quite well if we manage to pick the right companies. So to us, 25 stocks is never really an issue, and I would believe ultimately from an end investor perspective you would hold more than one fund. Yeah. In a way that you'll probably be holding multiple funds, so you will easily have like a few hundred stocks in your portfolio, not just 25. Yeah. And you gave me a good segue, because I think we've had a theoretical discussion about portfolio construction and the investment thesis. It's always, I think, I like bringing it to life by talking about actually in individual stocks, because I think it helps people understand the thinking. So starting point might be that you decided to sell out your entire stakes in Meta and Microsoft. Would love to hear a little bit more about that. You touched on Nvidia, but you've pushed that effectively to the limits of your UCITS position. So love to understand, actually what you're seeing in that. And then perhaps you can expand a little bit more on Leonardo, and I think European defense is a very interesting area and a big theme right now, and perhaps a stock like Apollo Global Management, which I also sort of picked out. So on a very high level, I think one of the USPs I would say that we might have over some of our peers is we consider ourselves as bottom-up business analysts. But sometimes I think that narrative is being misunderstood in a way that people think, okay, if you're bottom-up stock pickers, you don't really need to care about what's happening in the world because you just want to pick the right companies. I think we have a different view on this. Our belief is every company operates in the real world in a manner that will be certain regime or era that would be a tailwind to the benefit of the company. There will equally be a regime, which we would think that journey started back in 2022 and being exacerbated by Trump's tariff recently, that would become a headwind to the operation of the company.
Yeah.
So hence, when we think about, for example, European defense, have never really been a sector that we'll be interested in, at least since we started 8 years ago. But what have changed over the last couple of years, it started with the Ukraine invasion and later on followed by Trump's election. And now you can see that there's a lot of opportunities within European defense in a way that the European Union has been forced by Trump's administration to spend more money investing into defense.
Yeah.
That's never happened before.
Yeah.
So traditionally, if you look at European defense as a sector before recently, it's been growing at in line with the European GDP, which is, I think, on a nominal level would be about 5% a year, which is not interesting at all. But currently, the company that we have in the fund called Leonardo, Italian defense company, is growing at low double digit, just because of the tailwind they're getting under this new regime, which we would think is going to last for a bit longer. And equally, if you use the similar kind of mindset to assess the opportunity set for Nvidia, one thing that we spotted at the time was we like companies that are exposed to explosive growth opportunities. Okay, not just growing, but explosive. But the simple definition behind that is just to find companies or sectors that can capture a lot of spending within the shorter space of time.
Yeah.
Right. So everyone is growing. Mastercard and Visa, we like to. We will call them the steady growth. But Nvidia, over the last couple of years, has gone through an explosive growth journey. Right. So currently they're making $200 billion in top line versus $30 billion 3 years ago in 2022. So hence they have managed to capture a lot of spending in AI. And I think personally within Blue Whale that we are a true believer how generative AI is going to change the world. How we conduct our day-to-day, how we conduct business, etc. But the question mark, which is I think where our differentiator angle comes into play now, is we are very cautious about companies that are spending a lot of money into AI. And hence we recently exited both Microsoft and Meta. We like those companies. I think those companies are fine businesses. They are going to be around forever, so they're not going to disappear. We're not calling them to be not being a kind of big tech anymore. But I think the outperformance potential when you look at the return on invested capital profile, you look at the margin that we make on the back of AI, how much money they have put into place. At the same time, the threat from DeepSeek, which we think we're going to welcome a lot more startups coming into play, which doesn't mean the big tech would be very successful. I mean, I think they would probably ended up spending a lot of money acquiring those startups. So there's a lot of question mark in terms of AI spenders, but we want to be on the receiving end. So then the last point I want to make on this is you think about, okay, the reason why Nvidia is making $200 billion in revenue this year, and then the free cash flow margin is about 50%, is because the big tech company, the Mag 6, have decided to spend $300 billion of free cash flow investing into AI. So that we become on the receiving end. And that $300 billion, if we haven't got AI, it would have belonged to the shareholders of those Mag 6 companies, so including Microsoft and Meta. And it would not surprise you that Nvidia this year is delivering a higher level of free cash flow than Microsoft.
Wow.
Which is amazing, isn't it? But so then it's a zero-sum game that you want to follow where the money is being spent, and then you probably want to invest in a company who are on the receiving end of those spending.
And now, look, you're not shy of opinions. So one of the things that sort of caught my eye was that you sort of put out the statement that, you know, that the magic of the Magnificent Seven is largely done. And you are anticipating lower returns going forward. And I think you've articulated some of that in terms of capital returns on where they're spending. At the same time, you know, you have a significant US weighting in the portfolio. I think 70% when I looked. So how do you reconcile these two views? I mean, you know, how do you the exceptionalism that was there in terms of the US tech is under question, but you're still exposed to the US market?
Yeah, I think that's a very good question because obviously when we first started, I think the journey has been a tailwind in terms of US equities, the exposure to that, and then you get a bit of a strengthening of dollars. I think we are now probably in the reverse of that in terms of dollar being weakened, and a lot of people are trying to maybe explore other opportunities outside of the US. Hence I think there's a bit of a valuation reset in terms of relative valuation versus European equities. But what we are really interested in as a bottom-up stock picker is we want to find the one-of-a-kind companies. right? Like we're very pragmatic. Like this is not US fund. I mean, I could have launched an American fund 8 years ago, but I decided not to. Or I could have launched a tech fund, which I decided not to. Is that we want to launch a global fund that we are very pragmatic where the opportunities might be. Is that going to be in the UK, in Europe, or in the US? So we try to construct the portfolio based on a kind of the bottom-up opportunities. And I would say that there's still many one-of-a-kind companies that are being American, listed in America, that you want to invest into. So the examples that I would give, very easy to understand, would be Mastercard and Visa.
Yeah.
Would you not want to have exposure to them because they are American companies? Basically, two companies who control the world's payment network, making 50% margin. That we're all connected to this ecosystem. Whether you use your debit card or your credit card, you pay them a fee indirectly. And these are the companies that we're interested in. And of course, then if you then go into AI, very specifically Nvidia, there's only one Nvidia in the world, also happen to be an American company listed in America. But the other one that I want to highlight is Flutter, which we were an investor in Flutter when it was listed in London before it went to the US. And now is headquartered in the US. So I don't know whether you would consider Flutter as an American company today or would still be considered as a British company. But Flutter would be a company that we're very interested in. Doesn't matter whether it's listed in London or in the US, just because of the end market exposure, that's very special. But of course, I think what is very important to know as the journey progress is we would start to see some differentiation in terms of some highly kind of selective stocks that we ended up owning in the US versus the kind of the generic US stock market. Because a lot of people have asked me for the last many years, which my answer remain unchanged, is what do you think about the US stock market? My short answer is we do not invest into the US market. Within the 25 stocks that we have, we probably have about 10 stocks that are American. And I can give you the different investment thesis behind all these companies, but I have no particular view about where the US stock market is heading, because there's a collection of, 500 companies or 1,000 companies. I don't take a view on that, right? Like we take a view on specific company that we think they will continue to do well. So I think despite the fact that it's a bit of uncertainty, a bit of valuation reset in US equities, or exceptionalism being ended, or the world is shifting in the other direction, we do not think any of this would impact the earnings trajectory of our companies, whether they're being American or European.
Yeah, okay. I understand that. When we look at your operations, I mean, you're Mayfair based, you've got a remarkably lean team, 5 people sitting around a boardroom. I think understand that everyone is in the office typically at least 4 days a week. So I'd love to understand a little bit about your ethos around that, the culture of why being together is important. So walk us through the sort of thought process in terms of the team, the investment process, the dynamics, and why being together is important.
Yeah, so this is a very, very good question. I would say that this is one of the intangible assets that Blue Whale has that people don't see, because obviously you and I talking, you don't see how we operate as a team. But collectively, we do spend a lot of time together. So we debate, we go through new ideas, debate on existing investment thesis together as a team, the 5 of us in the room. And of course, I think what I picked up, I mean, when we first started the journey, everyone were in the office 5 days a week. And obviously then the pandemic happened and people have different priorities, and then we want to make it a bit flexible too. So currently we only allow people to work from home on a Wednesday. So we still got a full team of people on the other 4 days, which is very important. And ultimately, if you ask me, I think everyone have a different approach to investing. My way of thinking about this is I want to be the smartest person in the room. But the way to do it is you need to be surrounded with equally smart individual, right? And you try to then leverage onto everyone's know-how, experiences, and then you become smarter on the back of day. I would think that throughout the journey of Blue Whale over the last 8 years, because we ended up spending a lot of time together debating on stocks, talking about numbers, financial modeling, the quality of the businesses, I become a smarter investor compared to the many years I was working probably in a more silo that I was, obviously I think I'm smart, but you miss things, right? You have your biases, you read a report, you think like you can come to a good conclusion. But if you get your thesis being challenged by equally smart individual, they would probably bring out perspective that you might not have thought of. And so then collectively, I would think like successful investing is based on collective wisdom. And I would think that we have a very good team of individuals who are equally smart and hardworking. And then you can then bring the best out of the team. And then the collective decision of the team ended up to be probably the most optimal decision that we then translate onto the fund level. So I think that's a very important part of the culture that is probably not very visible from the outset, but this is a very important part, and we ended up spending a lot more time together than just like performing research in a kind of individual basis.
Okay. And I mean, just to understand a little bit of the sort of recent momentum, I mean, you know, look back at the sort of first quarter of 2025 was pretty choppy with the sort of tariffs coming in, etc. So just to touch on it, so what sort of, if you look back over the last three months, what would you say are the sort of key decisions in terms of what's dropped out of the portfolio and actually the key decisions and what's been added to the portfolio?
So on a very high level, we are very pragmatic, as we mentioned. I mentioned earlier that you need to be able to navigate the macro environments or different market conditions with the right stocks. And right stock meaning that they would not be impacted by the regime, let's say Trump's tariff, or they might be seeing benefit on the back of that regime. So European defense will be the opposite of that camp, right? They're actually seeing benefits. And at the same time, you probably want to have companies that are a bit transcendent or not being impacted either way. Like it's just going to continue its journey. I think AI is one of those journey that is continuing, powering on despite what's going on recently. But I think that's really important to keep reassessing what's going on in the world, and then you want to reposition accordingly. So what happened recently was on the back of Trump's tariff, on the back of, I think, what that tariff might then lead on to maybe a slowdown in the US economy or maybe globally. I think things are going to be a bit more expensive compared to before, with countries not working closely together versus many years ago, that we think consumer discretionary spending could remain under pressure for longer. I think that was a journey that we recognized back in 2022 with inflation being quite sticky, geopolitical uncertainties, and interest rate environment is going to stay higher for longer. I think that narrative now has been reinforced by Trump's tariff. So what it means is then consumer discretionary spending, of course, our wallets have limited kind of choices, then you need to be a lot more selective in terms of where you spend the money. And what happened with that is even though companies like Nintendo, which we have owned for the last couple of years, that we still like it, we still like the company, we have been anticipating the launch of Switch 2, which they did launch recently, but it's going to cost you $450, which is 50% more expensive than the current Switch they before the new ones being launched. And then the question would be, okay, the world is a bit uncertain. I think if you follow some of the companies that are making redundancy a bit, I think that it might show up in data at some point. Are you going to spend $450 to upgrade the Switch for your kids? You might, but you could equally postpone that decision to next year, right? You want to see how things going. You want to see whether things are settled down. So there's a lot of these things that when you then build a financial model, which is what we try to do, to anticipate what's going to change for the company's earnings trajectory, these would be an element that we need to then think about, which at the moment, I think the chances of that being kind of having some sort of impact would be a lot higher than if Trump haven't decided to go down this tariff kind of path. So what I'm trying to say here is there's a lot of things that we do in the fund level is being led by what's going on in the world. Of course, you have the bottom up stock picking. You pick a company because you think this is the direction of travel, but at the same time, you need to factor in where the world is heading. And it could become a negative or positive drivers in terms of where the company is going to go to. Okay.
And the fund's coming up for its sort of 8th year sort of anniversary. Are there plans to launch any other strategies? You're going to stick with what you've got currently? And if you're looking forward to H2, I think you've articulated quite a lot of the themes. Believer in AI, believer in the sort of European defence renaissance, Plus, you also said that you're a bottom-up stock picker, but is there anything else that you're looking at on the horizon that might be an interesting theme?
I think the difficulty of trying to anticipate what's going to happen is always a challenge. It's because you never know. I mean, I look back 8 years ago, I would never have anticipated the pandemic with interest rate being cut to zero, and then you have the mega inflation, and then you have the invasion of Ukraine, and now you have the Trump's tariff, right? Like, if you were to build a portfolio 8 years ago, it's impossible to anticipate all the different scenarios. But I think the beauty of an active manager, if you do your job right, is you have the opportunity to reflect the changes when it happened. So hence, I would say to you, like, based on what we understood today, I think the portfolio, the shape of the portfolio reflects the best opportunity. Despite like what we already know about Trump's tariff, etc., we think it's not going to impact the earning trajectory of companies too much. I think they will continue to shine, and hence then hopefully the share price would reflect those kind of earnings growth over time. And but it's a difficult world out there. So I would say that if you ask me, how do I find the investment opportunity today, investment opportunity set today versus 8 years ago or versus 5 years ago, I think our opportunity set has become smaller today than 8 years ago. The simple reason behind that is every company operates in the real world. So at the moment, there's many more headwind for a lot more companies than 8 years ago. 8 years ago, we didn't even have inflation as an issue. Interest rate wasn't an issue at the time. But today, like, there's a lot of things going on. Hence, then to find a company that could continue to do well is less easy than when the time is that everyone is making money, right? Today, not everyone's making money. So then you need to be really, really selective. And hence, I think we are trying to trying our best to find an opportunity, but you always have give and take. So hence, then you try to size the opportunities differently. But we'll see what happens, of course. I mean, if Trump decides to unwind every policy, then we might have a very different outlook, or maybe the shape of the portfolio would reflect that too. It could be quite different.
And there no plans to launch any other strategies, etc. It sounds like, particularly if you're saying the opportunity set's getting smaller, are you sticking with your guns?
I think for the time being, obviously, we have been doing this for 8 years now. I think the size of the fund is still relatively small. I think we would like to grow the strategy. But over time, of course, I think we're very open-minded in a way that we want to maybe consider other opportunities in terms of launching different products. But ultimately, I think we need to be able to do something better than the competitors or the alternative. So if we feel like we could consider a strategy that we can deliver a lot better than what's out there, then we will consider it. But I think for the time being, we'll focus on what we have.
Okay, perfect. Stephen Yiu, thank you very much for coming on Vantage. It's a big catch for me, Blue Whale, a big catch for me. I've been wanting to get you on the show for a couple of years. So thank you for running us through your thoughts, your investment process, and we look forward to staying in touch.
Thank you.